But first, we got to hit the balance sheet, the assets, liabilities, debts, and investments. So today in the assets column, I want to talk about local empowerment through local housing investment. There was an article written in the Main Street Journal by Michael Kantrowitz, and he talks about how recently the New York Times' Paul Krugman made an argument that one of the core elements of inflation is not only things like grocery and gasoline, but also housing. Shelter actually compromises a third of the consumer price index and about 40% of core inflation. So if you want to lower inflation, you should bring down rents and bring down housing prices. One smart way to do this is via cooperative ownership. And he's not actually talking about, luxury co-op apartments. Cooperative ownership is actually a smart strategy for something like mobile home buyers as well. For example, in Woodland, California, there is a mobile home park called Leisureville. And back in 1995, it became a limited equity housing co-op, which basically means that it is owned by the residents. And it's been a good move. The rents have only gone up 30% over the last 27 years. Compare that to a nearby mobile home park where rents have shot up to over 126%. And it just goes to show that when locals own and invest in their own community, it helps keep those rent prices in check. It's not just some theory. There have been lots of studies showing that consumer co-ops can offer cheaper goods than producer co-ops, and they can negotiate better prices for their businesses. So it turns out then that instead of relying on big bureaucracies like the Fed to fight inflation, we can indeed take matters into our own hands and invest in our own communities. It's a faster and better solution, and it can help avoid a lot of collateral damage. In the liabilities column, I'm going to talk today about the stock market boom and bust cycle. So Piper Sandler's Michael Kantrowitz, hope I'm saying that right, has had this framework for how to assess how the U.S. economy is doing during a hiking cycle by looking at housing, orders, profits, and employment. And according to Kantrowitz, housing is feeling the negative effects of higher rates, manufacturing orders are contracting, and corporate profits are slowing down. The only thing left is employment, and Kantrowitz believes that this will weaken too. He sees signs of a downturn, like the rising number of unemployed people. And while some on Wall Street are backing off recession calls, Kantrowitz is convinced that a recession is on the horizon. And if the unemployment rate continues to rise, it could suggest a recession is already starting. Small businesses are cutting back on hiring plans, and there's a relationship between home builder sentiment and rising unemployment claims. The October non-farm payrolls report showed weak job growth, and other leading recession indicators also point to a downturn. Many market observers see a recession coming in 2024, and Kantrowitz remains convinced that a recession is on the horizon and has a price target range for the S&P 500 that suggests a potential 20% decline. So I know I don't want to lose 20% of my money, but the signs are pointing to a weakening labor market with rising unemployment and other indicators suggesting that downturn. In the debts column, unfortunately, more bad news. The national debt, according to billionaire investor and author Ray Dalio, actually I have his book back here, the U.S. is heading for a bit of a turning point in its money situation. The government debt is growing faster than its income, and they keep borrowing more just to pay off the debts while continuing to spend like there's no tomorrow. The whole situation creates a problem with supply and demand. And to make matters worse, we've got political dysfunction and a bunch of other problems going on, which means that the credit rating agencies are even downgrading the U.S. credit rating and lowering their outlook on our debt. What this means is that foreign countries aren't as interested in buying our debt anymore, and about 40% of our debt is sold to foreigners. So this could cause some real trouble. Now, the total U.S. debt has skyrocketed to a whopping $33 trillion. Trillion's a hard number to wrap your brain around. And I always tell people, a million seconds ago was about 11 days. A billion seconds ago was about 31 years ago. And a trillion seconds ago, you're going back 31,000 years ago. And our national debt, as I said, is now over 33 trillion. And even though we don't actually have to pay back that debt all at once, we do need to cover the interest on that. And the problem comes in that the cost of servicing that debt is going up, which is not a good sign. It's making people doubt the future of the treasuries because demand is going down while the supply keeps going up. And what's causing this is the big central banks around the world. They used to buy a ton of treasuries, but now they are taking a step back and buying less. And even the foreign private sector is slowing down their purchase of things like US bonds, which is creating a domino effect. And all in all, we've reached a point where we do seriously need to consider the future of our country's finances. It is a big deal, and it could have a real impact on our economy and the financial markets. And as a reminder, in order to help combat this debt crisis, the Mindful Marketplace has partnered with local financial tech company Quility to provide all of our listeners with a free customized report on how to best eliminate personal and business debt while protecting your retirement accounts and other assets against market downturn. So you can get a free report on that by going to mindfulmarketplaceshow.com and click on the tab that says Eliminate Debt. All right, lastly, some good news in the investments column. Cutting Edge Capital, really cool group, has come up with what they call a diversified community investment fund. So Cutting Edge is a company focused on community investment funds, and they have introduced this new strategy called Diversified Community Investment Fund, or CDIF. DCIF, sorry, DCIF. This strategy involves a for-profit fund primarily investing in real estate while also allocating a portion of its portfolio to local businesses. The DCIF can raise capital publicly by using securities offering strategies. This allows the fund to attract investors from different economic classes, including residents of the community that they serve itself. Really cool. The fund can offer different types of securities and share profits with investors, and it may even provide limited liquidity options for investors. As the U.S. economy faces an aggressive Fed hiking cycle, community investment funds like these DCIFs offer an alternative approach to capital democratization. The success of this strategy will depend on how well it aligns with regulatory requirements and attracts investors from the community.